Hi class, in this video, I'm gonna go through the final sample test for the final exam. You'll also see the solutions to the sample test questions in this document, but I would always recommend you're working on these questions without looking at this video or the answers first. And then you could go through the answers and go through this video after you work on them on your own. When you're working on the questions, you could also refer to the final exam formula sheet. In our real exam, the same formula sheet will be provided. Okay, let's look at the first question here. Suppose a company has just paid an annual dividend of $2 per share for the year ended December 31st, 2018, its last reported fiscal year. The company expects to grow this dividend at an annual rate of 3%. The cost of equity for this stock is 10%. What is the price of the stock today? Okay, so this question is asking for the stock price, the current stock price. So we probably want to discount all the future dividends to present to get the stock price. Okay, remember we've learned dividend discount model. We've also learned corporate valuation model. Okay, corporate valuation model is more associated with the corporate cash flows. Dividend discount model is more associated with dividends. Since the information here we get is more related to dividend, so we will be using dividend discount model. We know that this firm just paid an annual dividend of $2. Okay, just paid, which means this is D0. Okay, any dividend that has been just paid or already paid, okay, or paid today, it's something that is already paid out. So you will not get this dividend if you purchase the stock today. Okay, so that's going to be D0. It's not going to be included in the dividend discount model, but we need to use this D0 to calculate D1. And we need to discount all the dividends starting from D1, D2 to D infinity. Okay, and because this dividend grows at a rate of 3%, so we have a constant growth rate here. G equals to 3%. Okay, this tells us we can use the constant growth model version of the dividend discount model. We also see a cost of equity as 10%. Okay, we could know that this stock return or cost of equity, okay, you can use either K or R to stand for this. It will be 10%. Okay, if you look at the final exam formula sheet in chapter 6, you will see the formula for calculating P0's current stock price. In the formula sheet, it's going to be P0 equals D1 over RS minus G. Okay, we can also use K to stand for RS. This is also D0 multiplied by 1 plus G divided by K minus G or RS minus G, because D1 equals D0 multiplied by 1 plus G. Okay, so if D0 is 2, 1 plus G is 1 plus 3%, D1 would be 2.06. And we can use this number divide by R or K, which is cost of equity 10% minus growth rate G 3%. We should get P0 or current stock price as 29.43. Okay, so the right answer here is E. Question number 2. You agree to take a 2-year mortgage of $11,227 with monthly payments of $500 at the end of each month. If the bank compounds interest monthly, what is the APR you will be earning? Okay, so this is a 2-year mortgage, but we pay monthly payments. Okay, so if we want to solve for the APR, which is the annual nominal rate, we will have to solve for monthly rate first and then multiply by 12. In order to solve for this monthly rate, we will need to input N, payment, PV, and FV. Here, N should be number of months, which is 12 multiplied by 2 years, which is 24. Payment is the monthly payment, 500, that you are paying to pay back your loan. And then your present value is the mortgage you take from the bank today, which is 11,227. Okay, so here we're standing from the bank's perspective. That's why 500 is positive here, meaning bank is having a cash inflow of 500 each month. And the bank has to pay negative 11,227 today. So it has a cash outflow today. So we have a negative sign for PV. For FV, after you pay off the balance after 2 years, the balance should be 0. So future value is 0. Okay, and then we compute for I, we should get 0.54 as the monthly rate. Okay, or and then you need to add back the percentage sign, okay, so that your monthly rate is 0.54%. And then we can multiply by 12, so we have 6.48% as our nominal annual interest rate. Question number 3. What is the present value of $100 be after 6 years at 10% compound interest? Okay, so this is the present value of a lump sum question. We know we're receiving $100 after 6 years. 10% is the compound interest rate, and it's yearly rate here, yearly payment. We need to input N as 6 number of years. We need to input I as 10, okay, because the yearly rate is 10%. So I should be 10. Remember, we remove the percentage sign when we input in the calculator. Future value should be negative 100, okay, and payments should be 0. We compute for PV, we should get 56.45, which is option B here. You could also input future value as positive 100, then present value should be a negative number. Okay, these two will be opposite signs. The following information relates to the following two questions. Suppose you are buying your first condo for $145,000 and you will make a $15,000 down payment. You have arranged to finance the remainder with a 30-year monthly payment, amortized mortgage at a 6.5% nominal interest rate, with the first payment due in a month. What will your monthly payments be? Okay, so you know that today you're buying a condo at this price. The down payment is $15,000. Okay, so you need to first take the difference of these two. You need to use $145,000 minus this $15,000. So you know that the mortgage you are taking today is $130,000. Okay, so you can input present value as a negative number of $130,000, which means that the bank is having a cash outflow of this much today. Okay, future value should be 0 since you're paying off this amount, and should be 30 years. Multiplied by 12, which is 360 months. Rate should be the monthly rate. You're given the nominal annual rate, so you need to divide by 12. 6.5% divided by 12 is 0.5412%. When you input in the calculator, you should input I as 0.5412. You need to remove the percentage sign when you input I. Okay, you compute for payment, you should get 821.69 as the monthly payment. Okay, and if you're looking for total interest payments, you need to use the amortization table. Okay, you should press second amortization, press down button, set PV to 360. Okay, meaning remember P1 is the starting period, it should be 1. P2 is the ending period, 360, because we have this many months. So now your starting period is 1, your ending period is 360. You're asking for all the information that covers all the years or all the months. You press enter, press down button, you will see INT, total interest payment, as 165,807.86. Okay. Another way to solve this for this question is that you know that you're paying 821.65 for each month. So after 360 months, your payment, your total payment should be, let me write here, total payments over 360 months are 821.69 multiplied by 360. Okay, let me calculate this number here. Let me pull out my financial calculator. Okay, this number should be 295,808.4. Okay, so if I use this number, total payments minus total principal, it will be this 295,808.4 minus our principal is 130,000. Okay, this is the amount of money that we're trying to pay back here. Okay, this is the amount we borrowed in the beginning. This is the beginning principal. So our final total interest payments will be 165,808.4. Okay, so it's about this number here. There are two ways to solve for this question. The numbers are a little bit off, but very, very close. Okay, so let me mark here. This is method 1, and this is method 2. Okay, so total interest payments equals total payments minus total principal payment. Remember, the total payments have two components. One is payments towards principal, another is payments towards interest. That's why we use total payments minus principal payment here. We have interest payments. Okay. Question number 6. The real risk-free rate is 3.05. Inflation is expected to be 4.25% this year, and the maturity risk premium is 0. Ignoring any cross-product terms, what is the equilibrium rate of return on a 1-year Treasury bond? Okay, so we're looking for 1-year Treasury bond return, rate of return. We know real risk-free rate R star. We know inflation rates IF. Okay, and because we're not, and the maturity risk premium is 0. MRP is 0. Remember, for short-term Treasury bond or any Treasury bond, we can just use R star plus IP, inflation premium, plus MRP. So we just add up these two numbers. Okay, you could see this formula in the on the formula sheet for chapter 5 as well. You add up these two numbers, you have option B here, 7.3% as the right answer. Okay, let's come to question 7. Biggers Enterprises bonds currently sell for 1,015. They have a 5-year maturity, coupon 2.0% or 1.0% semi-annual, a par value of 1,000. What is their yield to maturity? Okay, so we're looking for bond yield to maturity. We know the bond price, we know the years to maturity, we know the coupon rate, par value. So the present value should be the bond price we're paying today, which is negative 1015, cash outflow for us, negative sign. And should be number of half years. Okay, this is a semi-annual bond. So we use 5-year multiplied by 2, 10 half years. Payment should be the semi-annual payment, which is the semi-annual rate 1% multiplied by par 1,000, which is $10. Future value is the par value 1,000. Compute for I, we should get 0.85. So the semi-annual rate of return is 0.85%. We multiply by 2, we have 1.7% as our final answer. Question number 8. Bond price is 1050. 6-year maturity, annual coupon rate 7.5%, par value 1,000. What is current yield? You can see the current yield formula again on our formula sheet. And for bonds, that's going to be annual coupon payment divided by current price. Okay, for the annual coupon payment, we need to use coupon rate 7.5% multiplied by par value 1,000. We need to get 75. So current yield becomes the coupon payment 75 divided by bond price 1050. We have option A, 7.14% as the right answer. Question number 9. An investor has a 2-stock portfolio with 50,000 invested in Herbert Manufacturing and 150,000 in Biggers Corporation. Herbert's expected return is 6% and standard deviation of returns is 15%, and Biggers' expected return is 10%. What is the portfolio's expected return? Okay, in order to have portfolio's return, we need to use the weights of the 2 stock multiplied by the expected return of the 2 stock. And the weighted average return will be the portfolio expected return. So the first step will be calculating the weights for the 2 stocks. Okay, so for the Herberts, we have 50,000 in the portfolio. Okay, so first of all, we need to calculate weight for stock Herbert's Manufacturing. Okay, it's gonna be the amount that we invest in the portfolio divided by the total money in the portfolio, which is this 50,000 plus 150,000 invested in another portfolio. Okay, so that's gonna be 0.25. Okay, it's gonna be 50,000 divided by 200,000. That's exactly 0.25. The weight for stock, the other stock, Biggers Corporation, you have 2 ways to calculate for it. You can use 100% minus 0.25 equals 0.75, right? Because the rest of the portfolio is in the second stock. You can also use 150,000 divided by 200,000, okay, which is the sum of 50,000 and 150,000. Okay, let me just complete this here. Okay, so it could be more clear if we do this way, right? Okay, 0.75. Okay. Alternative way to calculate wait for beggars. Okay, and then the expected return of the two-stock portfolio will be the weights for Herbert multiplied by the expected return for Herbert, which is given here as 6%, which is 0.06, and then plus the weight for Biggers multiplied by the expected return of Biggers, which is 10.0%, which is 0.1. Okay, then we have the portfolio return is 9%. We also know the standard deviation here for Herbert's, but it's not helpful here in this question. Okay, the following data relates to the next two questions. Stock A has a beta of 1.2, stock B has a beta of 0.8. Portfolio P is a 300,000 portfolio consisting of 200,000 invested in A and 100,000 invested in B. Expected market risk premium is 6%, risk-free rate is 4%. Stocks are in equilibrium. What is the portfolio beta? Portfolio beta is similar to portfolio return, that it can be calculated as the weighted average beta for the stocks in the portfolio. Okay, so we again first has to calculate the weight for, okay, let me first calculate for weight for stock A in the portfolio. It is going to be 300,000. The amount invested in stock A divided by the total amount of portfolio, 300,000. So this is gonna be 2/3. Okay, and then weight for stock B in the portfolio will be 100,000 divided by 3,000, which is 1/3. That's why we use the two weights, 2/3, 1/3 multiplied by the two betas for stock A and B, which is 1.2 or 0.8. Okay, we use the weight for stock A multiplied by beta for stock A plus weight for stock B multiplied by beta for stock B. So we have 1.07 as the beta for the portfolio, option D. 11, what is required return? Okay, there are two methods here. The first method is that we can use the betas of each stock and CAPM to calculate the required return of each stock. Then we can calculate weighted expected return based on using the weights for the two stocks multiplied by the returns for the two stocks. If we go this way, the return on stock A will be the risk-free rate given as 4%, multiplied by the market risk premium given as 6%, multiplied by the beta of stock A, which is 1.2. So we have return on A, which is 11.2%. The return on stock B can also be calculated as risk-free rate 4% plus market risk premium 6% multiplied by beta of stock B equals 8.8%. Return on the portfolio will be the two returns we just calculated multiplied by the weights of the two stocks. Stock A is 2/3, stock B is 1/3. So return on the stock is 10.4%. Okay, I think this way is, the first method is not as easy or simple as the method 2. Method 2 is using the beta of the two stocks to calculate beta of the portfolio first. Okay, so it is repeating our question 10 first to calculate beta of portfolio. Using the two weights, 2/3, 1/3, multiplying by the two betas, 1.2, 0.8, we can have the portfolio beta as 1.07 that we already solved from question 10. And then the return on the portfolio can be using the portfolio beta to apply to the CAPM model, so we can directly calculate return of the portfolio, which is risk-free rate 4% plus market risk premium 6% multiplied by the portfolio beta we just calculated, 1.07, so the return on the portfolio is 10.4%. Question 11. Which of the following statements best describe what would be expected to happen as you randomly select stocks and then add them as a portfolio? A is the right answer. Adding more such stocks will reduce the portfolio's unsystematic or diversifiable risk. Option B is not correct. Adding more such stocks will always reduce the portfolio's data. Not necessarily. Okay, you have to compare portfolio beta, the old portfolio beta, with the new stock added. The beta of the portfolio can go up or go down, depending on the situation. Option C is not correct. Adding more such stocks will certainly increase the portfolio's expected return. Not necessarily. Okay, it also depends on the return of the old portfolio and the return of the new stock. The portfolio return can go up or go down depending on the situation. Option D is not correct. Adding more such stocks will reduce the portfolio's market risk. Remember, market risk cannot be diversified away. That's the bottom part in that diversification graph. No matter how many stocks you add into the portfolio, market risk cannot be diversified away. The upper part of the graph that can be diversified away is this unsystematic or diversifiable risk. Option E, adding more such stocks will have no effect on the portfolio risk. This is not true. The total portfolio risk will go down as you add more stocks because the unsystematic part will go down. Question 13. Suppose a company has just paid an annual dividend of 2.5 per share. The company has just launched a new product and expects dividends to grow by 10% for each of the next 3 years and then resume a long-term growth rate of 5% thereafter. The cost of capital for this stock is 15%. What is the price of the stock today? Okay, just paid dividend. Remember, this is D0. 2.5. The growth rate of the dividends in the first 3 years is 10%. So G1 here is 10%. Okay, and then after the first 3 years, we have a G2, a second growth rate as 5%. Cost of capital, which is R or K, is 15%. So we can use two-stage model or non-constant growth model of the dividend model here in this question. Step 1, we need to calculate D1, D2, D3, and D4. Okay, based on D0 and G1 and G2, we can calculate from D1 to Dn plus 1. Okay, the horizon date here is 3. So D1 could be calculated by using D0, 2.5 multiplied by 1 plus G1, 10%, so it's 2.75. D2 could be calculated using D1 multiplied by 1 plus G1, 10%, so it is 3.03. D3 could be calculated as D2 multiplied by 1 plus G1, 10%, so it is 3.33. D4 is a little bit different because it's in the second stage after 3 years. So we need to use D3 multiplied by 1 plus G2, which is 5% instead of 10%. Okay? So D4 is 3.49. Okay? After the first 3 years, we need to use 5% instead of 10% as the growth rate. As constant growth begins with the dividend in the 4th year, we can calculate the horizon value or terminal value here, P3. This is our second step, calculating Pn, which is P3 here, which is Dn plus 1, which is D4 here, over R minus G or K minus G. D4 is 3.49, we just calculated. R or K is 15%. G should be G2 here because we're discounting all the dividends in the second stage 2 times 3. Okay, so we use 5% here as G. The horizon value is 34.94. This is our second step. Last step is to calculate current stock price, P0, by discounting D1, D2, D3, and P3. Okay, you can use formula by using D1 over 1 plus K or 1 plus R, which is 1 plus 15%. Use D2 over 1 plus 15% square. Use D3 plus P3 over 1 plus 15% cube, and add them up. You should have stock price 29.84. Alternatively, you can calculate the P0 by using cash flow function on the financial calculator. You can input cash flow 0 as 0, cash flow 1 as D1, cash flow 2 as D2, cash flow 3 as D3 plus P3, okay? And then you can press NPV, input I equals 15, okay, which is the cost of capital, 15%. You remove the percentage sign, input as 15. Compute for NPV. You should get 29.84 as the present value of the as the present value of all the future dividends. Okay, you probably need to press down button too. After pressing NPV, you press down button, you see I, and you input I equals 15 by pressing 15, enter, and then you press down button again so that you can come back to NPV, and then you press compute so you can get a value for NPV. The following information relates to the next three questions. Tazzer Chemicals is considering projects S and L whose cash flows are shown as below. So our WACC is 7.5%. We have two projects here. The first project has a cash flow S. Okay. Today we need to pay 1100 as our initial cost, negative sign. And then in the next 4 years, our income or cash inflow will be 550, 600, 100, 100. For project L, our cash flow will be this second row here. Today we're paying 2700, negative sign, cash outflow. In the coming 4 years, our cash inflow will be 650, 725, 800, 1400. The NPV of each project should be calculated by using the cash flow function. Okay, so you can input cash flow 0, 1, 2, 3, 4 for the two projects in the cash flow function, press NPV, and then you press down button, you input I/Y as 7.5, which is our WACC. You press enter, so your I is inputted, and you press down button here, come back to NPV, you compute for NPV. Okay, you should get option A, that your NPV for L is 224.3065. Your NPV for S should be 86.2038. And then question 15 is asking for IRR for each project. Again, you need to input all the cash flows in the cash flow function. Then you press IRR instead of NPV, press compute. You should get option A here. That's the IRR for L is 10.71181. IRR for S is 12.24157. Question 16. As the two projects are mutually exclusive, tester chemicals should we need to decide, okay, which measure we need to go with. According to NPV, let's see, L has a higher NPV, so we should go with L. According to IRR, S has a higher IRR, so we should go with S. But remember, we discussed before, NPV is a better measure compared to IRR, so we need to go with NPV, okay? We need to invest in L, but not S, okay? According to IRR, we should invest in S, but we need to go with NPV here and invest in L. And it's mutually exclusive for these two projects, so we can only choose one of them. Last question, question 17. You were hired as a consultant to Everest Incorporation and you were provided with the following data. Target capital structure is 40% debt, 0% preferred stock, and 60% common equity. The interest rate on new debt is 8.5%. The cost of retained earnings is 11.5%. Tax rate is 20%. The firm will not be issuing any new stock. What is the firm's WACC? Okay, so remember the formula for WACC? If you don't, you can refer to our formula sheet again. You will see the WACC formula, okay? And it's in chapter 12. It is the weight for debt, preferred stock, and cost of common equity multiplied by cost of debt, RD, so WD is weight of debt. You need to multiply by RD, cost of debt, and then multiply by 1 minus T, 1 minus tax rate. Plus, the second item should be weight for preferred stock multiplied by RP, return for preferred stock, plus WC, which is weight for common equity multiplied by RS, cost of common equity. Okay, here we have actually only two components. We don't have the preferred stock component, or we can see that the weight is 0. So weight multiplied by cost of preferred stock would be 0. So our main focus here should be the debt component and common equity component. For the debt component, we use cost of debt, which is 8.5% is cost of debt, okay? Multiplied by weight for debt, 40%. We also need to multiply by 1 minus tax rate, 1 minus 20%, plus the second item for cost of, the second item for common equity. So we need to use weight for common equity, 6%, multiplied by cost of retained earnings, which is 11.5%. Okay, there's no new stock here, no new common equity, so we're using cost of retained earnings as cost of common equity here. And again, no component for preferred stock. So our final WACC would be 9.62%. We can choose option B here. Okay, so this is all the final sample test questions and solutions. You can always email me if you have questions. Good luck.